Hi everyone. Welcome to InvosTalk Advanced Learning Series. Today we are going to learn about trading in options. What is options trading? Options trading is a financial activity that entails the purchase and sale of contracts known as options, which grant the owner the right, but not the obligation, to buy or sell an underlying asset at a specified price within a specified time frame. Stocks, commodities, and currencies are examples of such assets. Trading options allow traders to profit from price movements in the underlying asset without owning it. It is a popular way to invest and can provide higher potential returns than traditional stock trading, but it also carries a higher level of risk. Options trading is done through registered brokers and can be done on various platforms, such as desktop computers, laptop computers, and mobile apps. As we have already covered call and put options in the previous videos, let us now see an example similar to real markets as to how the trading of options is done in the market for better clarity. For sake of simplicity, we will take examples of Nifty index call and put options. Let me give a brief fact before we proceed with the example. The option contracts are available with expiry of every Thursday in the Indian market. We are free to enter into a contract for the desired periods, however contracts will have an expiry date on Thursdays in the Indian markets. Let us now proceed with the example to gain more insight into the options trading. As on the 7th of March 2023, Tuesday, let us assume that the market opens on Nifty 50 index at 17,680. We have a call option contract for 17,700 having expiry on Thursday the 9th of March 2023 available for Rs 51.10. The price of Rs 51.10 is as per the expectation that at the time of expiry of the contract, which is on the 9th of March 2023 in our example, the market will be at 17,751.10, which is at 51.10 points higher than the strike price. Now the trader expects a bullish market, and as per his analysis the market shall go beyond the expected value of 17,751.10. Hence he enters into a call option contract at a premium of Rs 51.10. Now the trader who is the call option buyer has paid a premium of 51.10 and the option seller or writer shall receive the premium of 51.10. Now, let us assume that at the end of day, the market closes at 17,710 and the Nifty contract is trading at the premium of Rs 66.70. Hence it means that it is expected that the market shall close at 17,766.70, which is at premium of 66.70 from the strike price of 17,700. As we can see, the premium value has increased from 51.10 to 66.70. Hence the option buyer has already made a profit of 15.60. Correspondingly, the option seller has incurred a loss of 15.60. It is important to note that the trader is free to exit the contract at any time before the expiry of the contract as well. Now let us consider a similar example for put option scenario in the same market conditions. As on the 7th of March 2023, Tuesday, when the Nifty 50 index opens at 17,680, we have a put option contract for strike price 17,700 having expiry on Thursday the 9th of March 2023 available for Rs 84.45. The price of Rs 84.45 is as per the expectation that at the time of expiry of the contract, which is on the 9th of March 2023 in our example, the Nifty 50 index will be at 17,615.55, which is at 84.45 points lower than the contract value. Now the trader expects a bullish market, and as per his analysis the market would go below the expected value of 17,615.55. Hence he enters into a put option contract at 84.45. Now the trader who is the put option buyer has paid a premium of 84.45 and the option seller or writer shall receive the premium of 84.45. Now, let us assume that at the end of day, the market closes at 17,710 and the Nifty contract is trading at the premium of Rs 54.70. Hence it means that it is expected that the market shall close at 17,645.30, which is at premium of 54.70 from the strike price. Now the premium value has decreased from 84.45 to 54.70. Hence the option buyer has made a loss of 29.75. Another important point to note here is that the maximum loss that the buyer of the contract shall have to bear is the amount of premium paid, whereas there is no limit of the profits that he can make. This is because the premium can maximum go to zero and not below, whereas there is no limit on the higher side. The trader is free to exit the contract at any time before the expiry of the contract as well. Let us now understand other important concepts in options trading. The terms in the money, at the money, and out of the money refer to the relationship between the strike price and the current market price of the underlying asset. If the strike price of the option of the underlying asset is lower than the spot price, the option is considered in the money, ITM. If the strike price of the option of the underlying asset is equal to the spot price, the option is considered at the money, ATM. If the strike price of the option of the underlying asset is higher than the spot price, the option is considered out of the money, OTM. In the given example, the Nifty 50 index is assumed to be at 17,680. Now all the call options with the strike price of less than 17,680 shall be considered as in the money. Similarly, all the options with strike price of 17,680 shall be considered at the money, and all options with strike price above 17,680 shall be considered out of the money. Let us now understand what is option chain. Option chain, simply put, is a summary of all the open contracts as on date. The option chain contains the details of call and put options along with the details of open interest, change in open interest, last trading price, volume, as well as ask and bid price. All the above details are available on the website of National Stock Exchange of India. Another interesting concept of options trading is theta, or commonly known as time decay. Theta is the gradual loss of an option's value as it approaches its expiration date. It's a natural process that affects all options, as an option's time value decreases as the expiration date approaches. Theta is a formula that can be used to calculate the rate of option decay. All other factors being equal, theta measures how much an option's price changes over time. Long options typically have a negative theta value, while short options have a positive theta value. Let us consider this example to understand better. Considering the similar assumptions from our previous example, let us consider that on the 7th of March 2023 the Nifty 50 index is at 17,680 and the option contract with expiration on the 9th of March 2023 is available at Rs 51.10. Let us say that after the movement on the entire day the market closes at the same value, which is at 17,680. However, now the value of the option has decreased to 41.10. The decrease in value of the premium by 10 pounds or 10 rupees is called decay. As a result of this decay, the option buyer lost 10 rupees while the option writer or seller gains 10 rupees even though the market closes at the same value. To calculate the theta value for an option, we can use the following formula. Theta is equal to change in option price divided by change in time. In the example mentioned, change in option price is 10 and the change in time is 1 day, hence the value of theta shall be 10. The derivative market is a dynamic and exciting world with numerous opportunities for those with the necessary skills and knowledge. If you are willing to take up the challenge, we are here to guide you on this journey through the derivatives market. For more information, visit us at our official channels. InvosWealth.com. Follow us on Instagram at InvosWealth. For more such videos, subscribe our YouTube channel youtube.com/@InvosWealth.